Hey traders, this is Blake Morrow with Traders Summit, and it's Friday, so I have Jim Welsh from Macro Tides. He's going to be joining us right about, boom, there he is. Jim, good to see you. Happy Friday.
Happy Friday. Good to see you.
Good to see you. This is a weird week, I want to say. Um, this week, it looks like the markets are going to close a little bit lower, and I can't remember the last time that we've talked and we said, hey, this market, that I can remember saying, this market looks iffy at this point. So,
well, when we did talk last Friday, my expectation was that we were set up for a pullback, and there was a gap at 52.50. The 382 retracement, I think, was 52.04 or 5. And obviously, we got and traded underneath that today. And my view last week was that this was wave 4, this pullback, then would be followed by another push higher above the prior higher that we saw the week before. And my take is still that way. I think what happened today, which is interesting, my expectation was that the PCE, and we talked about this last week, the headline would be unchanged, but the core could drop by 1/10. And what happened is that the actual number was 2.75. They rounded it up. So that's why the core stayed at 2.8. Nonetheless, the month-over-month number was a little softer. And we saw, bond yields tick down. And I thought that when that happened, we would see the market rally. It did. And then after the market opened, the Chicago PMI came out, excuse me, and was at recession levels, like 35 versus the 41 they expected. And that seemed to take the air out of the bubble. And last but not least, NVIDIA, if you look at a chart, you can see kind of an inverted head and shoulders with a neckline at about 950, 960. The low was, I think, 750 plus or minus, which implied a rally of $200 above 950 to 960-ish, 1160, call it. It got to 1158, reversed hard yesterday, is down more today. So NVIDIA has been, the stalwart. You'd have to go back a little bit further to see this head and shoulders that I'm talking about. Yeah, there you go. You can kind of see the left side. You had to pull back for the left shoulder, the head at the middle, the right shoulder on the other side, the neckline. And so it hit the target that was predicated, and which implies to me that a pullback to the 960 range, the breakout level, is certainly possible. So anyway, you've all this in the mix. And what we're seeing is yesterday, the Russell was up pretty decently. It's holding up much better today than the big tech stocks. And that's despite Treasury yields ticking lower. So I just think, you had such concentration in NVIDIA semiconductor stocks that and I've talked about this in Monday's weekly technical or Tuesday's weekly technical review this week, Tuesday instead of Monday, that things have gotten really narrow again, and that the top 10 stocks are up to 35% of the S&P, and that was, I think, above like 29% in the last year or so. So things were set up so that if the heavily capitalized, big capitalized stocks took a breather, it was going to be felt. And I just think a lot of things have come. But the weak PMI number, Blake, seemed, because the S&P was up, I think, 10 to 15 points when that number came out, and immediately took the wind out of the sails.
Well, Jim, and I think you said something that I want to make sure everybody takes home with them. You're like, well, the Russell 2000 is doing well. The Dow, if you haven't looked, the Dow is actually outperforming today. So you're seeing rotation. It's not necessarily blind selling, and that would probably explain maybe some of the lack of. Now I know it's the end of month. There's a lot of end of month flows that are passing through the markets, but you're not seeing any currency really stand out. In the selling of NVIDIA, you're not seeing gold or any other asset class. So it's just really it's shuffling the chairs as the music's still playing, but the chairs are shuffling, right?
And hopefully we're not on the Titanic, right? No, you bring up a good point. End of month balancing, is maybe more prevalent because of the outside moves some of these sectors have made. People have to do some selling to bring them within maybe the guidelines. But again, my take has been at some point in time, the economy is going to show definitive signs of slowing. We're not there yet, but a reaction like today, is a hint that if and when we see that, the market may not like it. The whole idea has been, we may not get the Fed's rate cuts. They were looking for 6. Now we're down to about 1. But as long as the economy's okay, earnings are good, and that's what really matters. And as long as that story is intact, the buy the dip mentality will rule. And again, the pattern to me looks like the S&P needs one more rally to a higher high to complete the move up from April and potentially complete the move up from last October.
Go on.
And yeah. You can't have the car keys this weekend, and I'm not giving you any money for gas.
Well, all right. So you think the market's going to one more new highs? We're going to get into those charts, but before we get into those charts, we're going to jump into some of the other charts that you brought regarding. We're going to start with the inverted yield curve, but before I even do that,
whoa,
you're amassing quite a big audience that's listening in each and every week, and it's consistently been growing over the last couple of years that we've been doing these together. And I want to thank everybody for listening in every week. I know people are tuned in to hear you, Jim. So therefore, if you really are, you like what Jim does, make sure you give him a thumbs up. Jump down in the comments down below if you have any comments, especially as we go through these charts, and maybe you have some different views than him. And also make sure you email Jim for his most recent weekly technical review that was out on Tuesday
this week.
All right. But let's talk.
I look at the comments, I look at and respond to questions.
Good.
And there are people who say, I don't agree with you, Jim. And and I really appreciate, if you will, having a conversation with those who are tuning in and taking the time to express their view as well. So
look, markets are markets because there are differences of opinions. You don't have to agree, but having a civil conversation on why you would agree or disagree, that's the most important thing, so you can see every point of view. So let's go into the speaking of different points of view, let's go into your first chart, which is the inverted yield curve, Jim. And why hasn't this worked? I mean, tell me. It has been we've been inverted for 300,000 days, and it's still not working.
It is over, I think, 400. No, the reason why I did this, because we've touched on this from time to time, obviously. The Wall Street Journal ran a story this week, and this chart came from the Wall Street Journal, I believe, that article. Kind of like, well, you know what, the yield curve's been so out of whack, and maybe it's just wrong. It's time to kind of put this in the dustbin of history. And, this is the 1 year and 10-year inversion. A lot of people do the 2-10. There's also the 3-month versus the 10-year. But the bottom line is, if you look at the chart on the right side, you can see how inversions have consistently, reliably anticipated recessions. In other words, the curve inverted, and then with some lag time, and the average going back to the last 60 years is about 19 months, a recession has followed. That hasn't happened this time, although the 19-month window ended or was reached in January of this year. So we're not that far past, but I thought it might be interesting to look at, some of the factors that have maybe stretched that window in this cycle relative to prior cycles. So I don't know, I can't remember what the next chart is, but I'm sure it's really great. Oh, okay. This is showing job growth.
I'm sure it's great too, Jim.
This is showing job growth. And what we can see is, compared to other cycles going back to 1980, job growth in this cycle has been very strong. Now, obviously, you can see a lot of them went up for about 18 months, 15 to 18 months before they rolled over. and we're past that window of time. We've talked in recent months that there's been a big dichotomy between the increase in part-time jobs and full-time jobs that are measured differently in the establishment survey to the tune of about 1 million jobs. So historically, that divergence has developed prior to other slowdowns in the labor market, subsequent recessions. So irrespective, the bottom line is job growth has been much stronger. And on the right-hand side, it's showing the increase in the unemployment rate. And we can see is, it's up from what, 3.4
Yeah.
to 3.7, 3.8. I think we had 1 month at 3.9. It could set an all-time record, Blake, next Friday. If the May unemployment rate's below 4%, we'll have gone 28 months below 4%. The last time you got to 27 months or 28 months, whatever the number is, was in the 1960s.
And Jim, doesn't it make sense? I mean, the response to COVID, the lockdowns, the unprecedented response, not only from the U.S., the U.S. Fiscal and monetary stimulus, but globally, that you think, people talk about lag effects. I mean, so we're lagging even beyond what we saw in 1960, but what we saw 3 years ago, I guess it's 3 years ago, 3 years ago, is unprecedented, and was unprecedented. And it's beyond. So, I mean, to imagine that we could continue on even further than 19 months makes sense to me, at least in my pea brain.
Yeah. Well, again, the idea, you think about it, and you touched on this, when people were cooped up in their homes, they bought a lot of goods. And then once the economy reopened, you had an enormous amount of pent-up demand, people who just, were going stir crazy. Now they want to get out and live life. Plus, the government had distributed about $3 trillion to households. And that didn't spend a lot of it because they were cooped up inside their home. We've had unemployment that, as this chart shows, under 4% for more than 2 years. Wage growth has been pretty decent. People are earning money on savings. Up 4 years ago or 3 years ago, it was basically zero on savings. Now it's close to 5%. So a lot of things have come together, I think, that have contributed, because the biggest sectors that have seen job growth is leisure and hospitality, healthcare, because a lot of people didn't go to the doctor during COVID time because they were afraid to go. So you played catch up on that. And then, of course, government jobs. So the next chart looks at one aspect of what we just talked about is pent-up savings. Now, this is the San Francisco Fed. There are other estimates, since there's no formula per se to, well, how much is excess savings building and all the rest of it. So anyway, what these guys have found is that it peaked in 2021. Since then, the savings rates dropped from, I think, over 9% to about 3.4%, as people have been not saving money anymore, but they've been, whittling down this big, huge pool of savings. Now, the reality is, there's a lot of people who still are sitting on some decent excess savings because they're middle to upper income people. But the bottom 50%, Blake, when we look at auto defaults and credit card default and delinquencies, I should say, they're ramping higher. So again, we're getting anecdotal evidence that there's a portion of consumers that have run out of excess savings. And the other thing, net worth has increased very significantly over the last 3 years because of home values increasing. And I'm writing about this in the June Macro Tides.
Yeah.
And even if you're not, so the wealthy having, the top 10% got the bulk of the gains and assets. Well, why? Well, because they owned expensive houses before housing prices went up by almost 50% over the last 4 years. They've had stock portfolios that have gone up more. A lot of lower income people don't have a stock portfolio. And if you're a renter, you didn't see anything in terms of net worth increasing due to home price appreciation.
Yeah.
So my point here is that for the middle class, they've still seen their home value increase significantly. And even if you're running down your savings, you kind of feel like, you know what, if I need to, I could get a home equity loan. And if if I'm older, I can always sell my house and get a big windfall of money. And I think that psychological boost of net worth, even for middle income people who didn't enjoy the same fruits as the upper income, still psychologically, I think makes them comfortable with drawing down savings and continuing to spend. But the point being is that's a game that has a time clock. And sooner or later, more and more consumers will get to the point of, honey, I think it's time that we're not going to go out to dinner 3 times next week. We're going to go out twice and so forth. So anyway, but this is, I think, one of the reasons why the inverted yield curve has been stretched in terms of the lag, because consumers, there has never been a post-recession period where consumers had this much money. In fact, it's usually kind of the opposite because the unemployment rate was high and stayed high. So anyway, that is one reason. The other reason, which is the next chart, is government spending. Now, going back to 1960, you can kind of see, rarely do we see a deficit, even during periods of recession, where the deficit exceeded 5%. You got spikes, obviously, 1982, you can see it popped over 6%. Immediately declined. 1990, there was a recession. Didn't even get to 5%. The 2001 recession, the deficit was maybe 3% of GDP. 1970, it was like 2.5%. Well, okay, the pandemic hit, you get this big explosion. Okay, we understand that. But the economy grew over 3% last year, and the deficit was over 6%. And the point is that the Congressional Budget Office projects that the deficit is going to hang around 6% for the next 5 or 6 years, and they're not even factoring in the potential for a recession. The way they do their numbers is we don't see a recession until one obviously really shows up, and then the numbers kind of blow up. But my point is deficit spending and the specific bills, the Inflation Reduction Act, which is, it's quite a name.
Don't laugh. Don't laugh. You're about ready to.
Yeah, the CHIPS Act and so forth. My point is, we've never seen this kind of fiscal spending as the economy has long exited a recession. And so that's another thing that is working counter to what the Fed has done with monetary policy and the yield curve. Now, some of this spending is going to slowly, even if the deficit stays high, because some of the deficit is obviously interest expense, which has gone up several $100 billion in the last 3 years per year, and I think it's going to hit $1 trillion this year. 4 or 5 years ago, it was around 350 billion.
I mean, and that's with you thinking that the Fed has to cut rates. They have to as a result of this. But how about if they don't? Yeah, that's a whole nother ball.
Well, what's going to drive the bus is the economy. That's, in my view, Powell has said the economy, not politics, is the main factor in guiding policy. I believe that he's right about that. And but at some point in time, that is going to become a problem. And that's a conversation for another day. So, but the point being is, the article in the Wall Street Journal is kind of like, I'm tired, like you were saying, I'm tired of hearing about the inverted yield curve. It's been like that for 300,000 days, or whatever you said.
Right.
And so to me, that's like, okay, let's see if we can understand, are the reasons why this thing has gotten stretched. Again, the average going back to the last 60 years is 19 months. We're what, 4 or 5 months beyond that? So I kind of think that those who are kind of dismissing the yield curve are going to be surprised.
Yeah, and you pointed out average, and as we discussed, this time is different. I mean, it is different.
Right.
The policy response globally was different in a big way. So anyway, I hear what you're saying, and I think people that are they're forgetting the recession calls. there's definitely a lag. And what you're saying is the lag could still continue on, but it's still very much a big risk in the economy right now.
I think it's going to be an increasing risk as we go, between now and year end. That's
Okay.
my take. All right.
Well, so tell us what it means for the dollar, because as we've been discussing, the dollar, having a hard time wrapping my mind around dollar weakness. But Jim, and I'm just going to say this to you out loud because I know this is your show, but I had to go back to
Sure.
the .com bubble and realize that the dollar did get whacked. As the U.S. economy and the world economy, for that matter, slowed following the .com bubble, and it continued to slow, or the dollar continued to come down as we came out of the 2000 to 2000
Financial crisis.
well. So
Yeah.
heads
Well,
up.
there were some other things. The dollar index was up around 121, I believe, in 2001 or so, maybe 2002.
Yeah.
The Treasury Secretary at the time, I think the guy's name was Steele, and basically he made comments that, yeah, we want a strong dollar, wink, wink. Whereas Rubin during the 90s, the markets believed a strong dollar is in the best interest of the United States, and people believed it. And so, to me, the keys that can potentially come from an administration also are a factor. So, the economy, .com unwinding, 9/11, all those things contributed to the dollar's weakness then. But I think the overall thesis is that during periods of weakness, the dollar or any currency is probably more vulnerable to a decline. And so, to me, looking at the chart, I've been looking for a pullback. We've been getting it. The rally from the recent low at 104.08, you can see it's very choppy. I mean, that to me, we had a decline from 106.50 to 104, and we've got this really kind of bounce that looks very choppy, labored, and my take is it looks like an intermission prior to another leg down. So I continue to believe that at a minimum, we'll see the dollar test that upper trend line underneath current prices. Equality in terms of the decline get you to 103.74. Ultimately, I think the dollar can go under 103, 102.50. And bigger picture, I think we'll see the dollar in the low 90s by the end of next year at some point in time. So, again, the idea being is that the economy is going to slow more than expected, and the dollar has benefited from being the strongest economy on the planet for quite a while. And I think when people see that is weakening and changing, I think the dollar weakens.
Well, gold has been another thing, Jim. You would think that with the dollar, not rallying, you would think gold would stay fairly strong. But we've seen the gold market weaken a bit.
Yeah, the expectation, as we talked last week, a few weeks ago, is like, I think we have a rally above 24.27. We got it in overnight trading on a Sunday night, May 20th, and then you had a big reversal. And what we talked about last week was that potentially was wave B, not wave 5, but wave B. And if you go back to December 4th, April 12th, prior big reversals in gold, it ushered in a window of time of correction, both in time and price. And my conclusion last week was that reversal on May 20th suggested we were going to see gold decline more. And if the idea that the decline from 24.27 to 22.81 was wave A, the spike to 24.49 was B, good chance that wave C is going to take it under 22.81. And so, to me, the thing you just noted is, the dollar hasn't been acting all that great, and gold hasn't really been running with that. It kind of reinforces the outlook that we're going to see a pullback that undercuts 22.81. Now, from the low way back on the far left, last September, October, I think the high at 21.22 was wave 1. We had that period of correction for wave 2. The rally to 24.27 was wave 3. This is an A, B, C for a wave 4. So once this is complete, my bias is that we will see a move to probably close to 2,500. So if that pattern analysis is correct, it says, okay, gold trades under 22.81. You want to start looking to be a buyer.
All right.
In anticipation of wave 5 to a higher high.
Your mouth, your lips to my ears, I guess. Is that what we say? All right, TLT.
Well, I don't care about your ears, but going directly to the gold market might matter, you know.
All right. TLT, we saw a correction. Yep. So how are you reading this now?
All right. Last week, the expectation was we were going to see Treasury yields tick higher. They did. The low that we saw on Wednesday at 88.68, I think is wave 2. So, you know, from the low we recently saw at 87.34, to me, it looks like you got 5 up. You can look at Treasury bond prices. They look like they have 5 up on both the 10 and 30 year. And I think the low that we saw at 87.34 completed a wave B correction that started after TLT hit 100.57. So the big picture here, Blake, is that low at 82.42 ended a 5-wave decline from March of 2020 when TLT was 179 and change. Think about that, from 179 down to 82. That implied, way up there. No, for me, that implied that we were going to see a significant retracement of that decline. And the 3.8, well, I think the 238 is about 105, the 382 is 119. And so within that framework, the rally from 82 to 100 was wave A. In late December, we thought we're going to have a pullback here. People are crazy thinking there's going to be 6 rate cuts coming. And we saw TLT pull back. The next move should be wave C that takes it above 100. I think 105, 109 is a reasonable target. And therefore, that 5 up is wave 1 of C. This pullback is wave 2 of C. And obviously, the litmus test is the declining black trend line that has basically contained every rally since it peaked at 100.57. So confirmation that this thing is really getting going will be a convincing close above that trend line. Think it's going to happen. But that, again, this is predicated on the economy slowing more than people realize.
Well, we have a jobs report next week. So
yeah. And I'm not sure that is going to be like, oh my God, it's terrible. But I think job growth is going to continue to moderate. And by the time we get to later this year, early next year, I think there'll be a number that comes in with a minus sign in front of it.
All right.
But that's a ways away.
That is. All right. Well, here's the S&P. What does that mean for stocks, Jim?
Okay. The expectation was that we were, as I said earlier at the beginning, a pullback, 52.50, because there was a gap there, 52.04. We've obviously undercut that. I put this chart together an hour or so ago. As long as we hold above 51.23, which is the high for wave 1. So if this is wave 4, you can't overlap wave 1. And my bet here is that we'll see a low, and then I think we're going to see the S&P rally to a higher high before a much more significant and important top takes hold. So in the last week or two, my advice to readers of Macro Tides, do some selling above 5,300 just to be careful, safe. Because I think we're going to have a pullback, and it could turn out to be deeper than expected, but at a minimum, we should see a pullback to the numbers I just talked about. And we've seen the broad market act much weaker, so the broad market is down a lot more prior to yesterday, at least, than the S&P. S&P is kind of playing catch up because we're finally seeing the weakness in the tech stocks. But a lot of times, Blake, when a group has been such a stout leader, when it finally corrects, everybody thinks, oh, okay, now we're really going to get it hit. And it's kind of like you get that pullback in the leaders, and then it's like the stuff that was correcting before has already started to bottom out, which is kind of what the Russell's implying.
Yeah.
And then you get a rebound in those tech stocks or the leaders again. And the key will be the advanced decline line has consistently made higher highs as the S&P made a higher high. If the S&P does manage to get above the prior high and the AD line hit a lower high, to me, that will be justification of becoming much more, cautious, if not outright bearish.
And Jim, I have a sneaky suspicion that might be a chart that we're going to be looking at next week as we hit new highs. So with that,
or the week after.
Well, yeah. So, but 1 week at a time. With that being said, I want to say, Jim, thanks for walking us through the markets each and every week. I appreciate you. If you guys appreciate what Jim's doing, make sure you give him a thumbs up. Check out Macro Tides when you get a chance. And Jim, I hope you have a great weekend. Okay.
You do the same, Blake. Thank you, buddy.
Thank you so much for hanging out with us. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.